Hi, I'm James Robinson, and this is my stock pick of the week. So before I do this video on Tesla, I should let you know that I've already done one video on Tesla. I did it on April 2nd of 2019. And when I did that video, Tesla was $285 a share roughly. And I suggested that the economics for the company weren't very good, the fundamentals were horrible, and that while I liked the product, it wasn't a company that I thought you should buy. I don't tell you to short sell stocks because I think short selling is an asymmetrical bet, but I did tell you that I thought it was an uninvestable company. Subsequently, Tesla went from $285 a share to $185 a share, and I looked like a genius, obviously. However, since then, I haven't looked quite so smart. Tesla's gone from $185 to over $975 the other day, and that's when I decided I needed to take a new look at Tesla. I wanted to understand what was going on and what I was wrong about, or alternately to understand what it was about Tesla that should lead me to continue to be convinced it's a bad stock. We all have, when you're a value investor and you have this fundamental kind of curmudgeonly look at stocks and say, look, it has to have good fundamentals, has to have good profits, has to have good debt. I want all these solid things in a stock. You inevitably have these friends who are more swashbuckling, right? They're, looking at charts and they think you're an idiot, and they, inevitably will point to the fact that they bought stock in Tesla at 185. They always buy it at the low, and now it's at $800-900 a share. And yeah, you've got all these great spreadsheets, but what the hell do you know? Because you totally got it wrong about Tesla. And on one hand, they're right. I mean, I was wrong about Tesla and it quadrupled in value, but I'm not wrong that Tesla doesn't have any value. I don't think this company is investable, and I still don't think so. But having said that, I wanted to go back and relook at it and understand it. I think when you look at this video, you're going to want to send this to your friends who own Tesla stock and hopefully convince them to sell and take their profits. I don't want anyone to lose money. I'm very happy for them to make money. But they should get the hell out because there's nothing here. It's smoke and mirrors. And I hope you're going to see that as you go through this. So if you like this video, then share it with your friends who you think might own Tesla or you think might be contemplating buying Tesla. And maybe it will save them from, I think, inevitable heartbreak as to what's going to happen next. So I mentioned that I've already done a video on Tesla, and I'm going to put a link to that. I don't know if I'll put it in the comments or up in the corner. I have to learn how to do that, but I'll do that in the next few minutes. So you'll be able to go back and watch that. That is a look at Tesla fundamentally. It was done in April. Not much really has changed fundamentally, and I stand by everything that I said about the company then. This is going to look at Tesla differently. This is going to look at the company through different prisms than you might ordinarily look at. And really it's looking at it for the prism, is this company overpriced or is there something goofy going on here? So I've got 15 charts, and each of those charts will tell a story from a different perspective. And I think when you add it all up, you'll come to maybe the same conclusions that I have. So the first chart, actually two charts, but I'm calling it one chart, are Tesla's earnings and Tesla's earnings per share diluted. The first thing that I want to point out here is, this is going to sound crazy, but the goal of a company is to make money for its owners. That's the job. How they do that, what their product is, all that's secondary. The question is, as a stockholder, can this company make money for me? And when you look at this chart, you'll see that Tesla has never come close to making money for its shareholder. It's been losses all the way back to 2005. Those losses have been enormous in some years. They're slightly less enormous now, but the company has never been a winner. Elon Musk has made a fantastic product. I love Tesla cars. I would buy and looked seriously at buying both the Model S and a Model X. When they came out, I would, if it wasn't so ugly, I'd look at buying the Tesla truck. But having said that, that doesn't change the fact that as a company, it's not very investable. It has never shown any profit. You're going to look at what's happening with stock buybacks, which there aren't any. You're going to look at what's happening with dividends, there aren't any. And when looked at it through that simplest, most simple of lenses, I don't know how a stock gets to $985 a share when it's never made a penny of profit. This is all I need to look at to never have an interest in this stock. And by the way, if this doesn't change dramatically, I'll be 100% right. In the long run, the company will be worthless. But that's the first thing. And it's so simple, and it's hard for me to understand why anyone buys companies that can't turn a profit. I know that Tesla has all this blue sky, and I know that everybody thinks they're going to have the semi work and the roof work, and all the cars are going to work, and no one's ever going to compete with them. But none of that necessarily is true, and all we know for sure today is they can't figure out how to make money. This is the next chart, and it's very important. This is the chart of since 2017 the price of the stock. And this chart makes me look like I'm empirically wrong. And by the way, if you'd bought stock when I told you to sell, you'd look like a genius, and I look like a knucklehead. I don't think that the final word is written yet on Tesla and on who's right or wrong on this. And by the way, I don't necessarily want to be right. I don't want anyone to lose money on Tesla. But I do think the next few slides we're going to show are going to belie that this doesn't make sense. So one of the great things about the internet is that you can, and YouTube, is that you can quickly amend a video and change it or add comments to it. So I'm going to do that. I posted this video a day ago, and Andagap, who's been a longtime follower, subscriber of mine, brought up several points. He brought up that Tesla's a first mover and that gives it an advantage, that Tesla has a technological advantage, and that as a result of that, I'm not really giving Tesla any credit for that in my analysis. And actually, that's not really true. I do give Tesla credit for it. Like I said, I would be a consumer of Tesla. I would consider buying one of their cars. I would consider doing the solar roof. But as an automaker, I think that its technological advantages are very small. And I also think that they're going to erode very quickly. I just read an article that I'll post on Twitter. There are 40 new electric vehicles going to be produced between now and 2015. That's 40 new competitors. They're all going to be, basically the same technology as Tesla, plus or minus a little bit. Tesla is trying really hard to do self-driving cars, but, they're being vastly outspent by Waymo and Apple and others in that category. But what I really wanted to do, what I'm doing on this slide is I'm looking at the R&D. And my theory is if you're being outspent on R&D significantly, that it's just a matter of time. It's like the peloton in the Tour de France, right? You can be the guy out front, but if everybody is chasing you and they're all drafting off each other, they're going to catch you sooner or later, and probably sooner. To put things in perspective, Tesla spends about $1 billion, $1.6 billion on R&D. That's about 2% of the R&D spent by the largest auto manufacturers. So 98 cents out of every dollar spent on automotive research is spent by Tesla's competitors. And don't forget, the first thing they're going to do is they're going to buy a Model S and a Model Y and a Model 3 and a Tesla Semi, and they're going to literally take it apart piece by piece by piece. They're going to take the batteries, they're going to send them a bunch of PhDs with electrical engineering or whoever the hell studies batteries, chemists, whatever, and they're going to break that part down to the barest essential parts, and they're going to figure out what Tesla is doing. And then they're going to go to work on trying to do it better. Let me put them in a different set of perspective. Tesla has 50,000 total people working for it. That's their entire workforce. Mercedes-Benz Daimler has 25,000 people working in their R&D department. I mean, the fact is, Elon Musk is a brilliant guy who's come up with some brilliant things, and he should be applauded for it, and I don't resent him being a multi-billionaire as a result of it. But that doesn't mean that Tesla has a durable competitive advantage. I think they have a competitive advantage today, but I don't think it's very durable. I don't think there's anything that they do that's that special that can't get beat. In fact, if they do anything that's brilliant, it's the charging stations, not the cars. So, talking about first movers, people say, hey, Coke is a first mover, and the example Andagap used was Apple is a first mover. Apple wasn't the first mover in cell phones, right? The first mover was Motorola. BlackBerry was the first smartphone. Those guys both got crushed by later competition. And that happens all the time. Ford Motor Company and GM were not the first car companies. The first first airline manufacturer was not Boeing, and it wasn't Airbus, it was Wright Aviation. RCA was the biggest TV manufacturer in the world, and now I don't think they even exist anymore. And it goes on and on and on. Think about Blockbuster for delivering movies. Think about VHS as a way of consuming movies. Then it went to CDs, and now it's all streaming. The world changes quickly, and if the reason your company exists is simply because it's the best technological company, it's probably going to get just ground down over time. You have to be able to have the best company, and you have to execute. And one of my concerns with Tesla, as we'll see, is that it doesn't execute. So I really appreciate the feedback, and I love the debate. And by the way, Andagap, to his credit, bought the stock apparently at 200, now it's at 900. So he's made an awful lot of money, and he's more right than I am because he has Scorecard. But I'm just trying to say, maybe take your money and run. Go go do something else with it, because I think that this is not sustainable. So I read somewhere that Tesla was now the second largest automaker in the world by market cap. It's not the same thing as by percentage of sales or anything, but just in terms of market cap, it's the second largest auto manufacturer in the world. And that struck me as really kind of hard to fathom and hard to understand. So what this chart looks at is you take the 10 largest auto manufacturers, that's about a $750 billion group of companies, and you figure out Tesla's place, and they've got about 23% of that share. So that to me seems really hard to understand and hard to accept. I know that the general scale of the company is small, and yet there's and I know they don't make money, and I know the other 9 companies on this list all do make money. So I wanted to be able to graphically show that to you because I think it dovetails nicely with the next slide. So juxtapose the fact that Tesla has 23% of the market share based on market cap. This is Tesla's market share based on cars sold. So this shows that Tesla has sold 1% of the cars. That's actually an exaggeration. It's just that Tesla has sold 0.6 or almost just basically half of a percent of the shares sold. So it has 23% of the market cap based on market share, even though it's selling less than half of 1% of the total cars produced by these 10 largest global car makers. So that should strike you as being odd, right? How can a company's market cap be 50 times as great as its percentage of the sales in the marketplace? So something is goofy going on there, right? Doesn't that make sense? So let's look at this another way. The 10 largest car companies in the world by market cap are Toyota, Tesla, Volkswagen, GM, Daimler, Honda, BMW, Hyundai, Ford, and Chrysler, okay? Those 10 companies have a combined market cap of $750 billion. That means stockholders have invested or would today invest $750 billion to own those companies. The combined income of those companies is $63 billion. So that equals an implied PE ratio for the entire industry of 11.9. So again, if the auto industry was one company, then that company would be worth $750 billion, it would have $63 million in profit, and it would have a PE ratio of 11.9. So this chart shows the PE ratio individually for each of the companies in question. Hyundai is at the high end at just over 22 times earnings. Chrysler's at the low end at just under 7 times earnings. But most of these companies kind of fall in a narrow band, and they don't trade at very high PE ratios, but here's what they all are. Now let's look at this exact same chart, and let's throw Tesla and its PE ratio into the equation. So here's the problem. Before I show you that chart, we have to go over something. Tesla lost money last year. That means that the company doesn't have a PE ratio. So let's change that. For the sake of this analysis, let's say that instead of a loss of $665 million, which is what Tesla actually had, that they found a magical accounting error, okay? So they didn't have a loss of $665 million. Let's say they actually had a profit of $665 million. So for the sake of this conversation, we're giving them a mythical gift of $1.3 billion that they did not earn, but we're gonna give it to them for this analysis, and that will change their $665 million loss to a $665 million profit. So when you give them $1.3 billion of profit they didn't earn, all of a sudden you see that the entire auto industry trades in this very narrow band between 7 and 22 times earnings, and then there's Tesla. So Tesla trades at 265 to 262 times earnings. And that's if we give them a $665 million income that they didn't earn, they actually lost $665 million. So all of a sudden you go, how is this possible? How can this company trade, effectively 10 times where the market's trading? And that's on top of the fact that we know that the market cap is enormously high relative to the very fractionally tiny number of cars they actually sold. Okay, so let's look at this now through another prism. Let's talk about book value. Book value, we haven't talked about that much. Book value refers to the total amount a company would be worth if you liquidated all of its assets and you use that money to pay back all of its liabilities. And what would be left is the book value of the company. So why do I bring that up? Well, the largest auto companies, excluding Tesla, have a market cap of about $583 billion. Their combined book value is $592 billion. So effectively, they trade at 1 times book, okay? Now, that implies, and that's for the entire auto industry. Again, if all of those 9 automakers were combined into one company, they would have they would trade it at basically book value. Here you can see the chart of where the individual companies trade. Volkswagen trades at about 2 times book, and some of these companies trade as low as 0.5 times book. But it all averages out to the companies trading at about 1 times book value. In fact, Ford trades literally exactly at 1 times book value. So here you can see the chart now with Tesla thrown into the equation. So I've shown you that the industry as a total is worth about book value. And I've shown you that the individual companies trade in a relatively narrow band, somewhere between half book value and 2 times book value. So there's a very narrow band. There's a lot of homogeneity in all of these stocks, right? And then here's Tesla. Tesla trades at 26 times book value. Explain to me, what is it that makes Tesla so valuable that it should trade so differently from the rest of the auto industry? And remember, this is not a new industry. This is not a small industry. It's not an industry people don't understand. It's 100 years old. It sells 55 million cars a year. We all interface with these cars every day. You have been in or seen a car from every one of these manufacturers. You know which ones you like. You know which ones you don't like. They know each other. They spend a tremendous amount of time studying each other. These guys should all be trading in a very, very narrow band. And yet here's Tesla. It's trading at 26 times book value. Why? It doesn't have these fantastic profits. It doesn't have no debt. There's nothing that makes Tesla trade at this price. Something doesn't add up. So yet another way to look at this problem, at this company, and try and figure it out, this industry to try and figure it out. What I've done here is I've taken the market cap and I've divided it by the number of cars that the company sells. And the idea is every time a company sells a car, there's some profits associated with that, and those profits add up to the market cap. And so what I wanted to understand is, how does each car sold inform us as to the value of the company, right? So you can see that BMW is worth, call it $17,000 for every car that they sell. Toyota is worth a similar price, and Daimler goes down. And basically the quality of the car being manufactured really impacts the market cap for the company sold. But when you look at this, you'll see that the market cap increase for every car sold is somewhere between $7,000 and $17,000. So it trades in, again, this narrow band, and as you would guess, the more respected manufacturers trade a little higher price in market cap for every car sold. But again, there's real homogeneity between these companies until you look at Tesla. When you look at Tesla, it's just astonishing. All these other companies trade at between $7,000 and $17,000 of additional market cap for every car they sell, but not Tesla. Tesla trades at $500,000 additional market cap for every car they sell. I don't understand. They don't even make a profit on every additional car they sell. In fact, every time they sell a car, they lose a little more money. But somehow the market is deciding that every time they sell a car, that should be worth $500,000 a year more in market cap. And I don't understand what the market is basing that on. I don't understand why the market is giving Tesla credit for this. But it is, and I'm again suggesting these things are all adding up to something smells fishy. Something is rotten in Denmark. This looks at the number of employees that these companies have. And my thinking as you do this is perhaps there's a real value in the size of the company. And more importantly, the number of employees should inform as to the ability of the company to produce more and more cars. You can't produce an unlimited number of cars without the right number of employees to do it. So when you look at this, you see Volkswagen, which is amongst the most valuable companies in terms of market cap. They have over 600,000 employees. Toyota and Daimler, which again are amongst the most highly valued companies, also have a lot of employees, 350 and call it 300,000 employees each. And on down the line, and then you see tiny little Tesla. Tesla has 50,000 employees. They have less than 1/10 as many employees as Volkswagen, 1/6 as many employees as Toyota. What that tells you is that if Tesla got the number of orders today to produce the number of cars that Toyota makes, 10.8 million cars, that's what Toyota makes, versus 350,000 cars for Tesla. Even if Tesla could today start getting the orders, they don't have nearly the employees. They need 10 times the employees they have to produce the cars they need to produce, if they could then produce those cars as profitably as the market, to be able to justify their market cap. So people that are saying Tesla's going to grow into this, some are going to magically become able to produce enough cars to be not only profitable, but profitable, competitive with the auto industry, they'd have to increase their workforce by 10 times. And I don't understand how they're going to do that. And I especially don't understand how they're going to do that in, California and in America where, we have 95% employment. Where are you going to find 300,000 qualified workers to go build cars for you? And what's that going to cost? So then I thought about it. And the more I thought about it, the more I thought, well, maybe the key to Tesla isn't the number of employees they have, it's what their employees can do. That their employees are in some ways so much more efficient that justifies this market cap. That they not only have built a better mousetrap, but they've built a better mousetrap building machine, right? And so I looked at how many employees a company how many cars a company is making per employee. So Hyundai is making, call it 55 cars per employee. GM makes, 45 cars per employee and on down the line. And what you see when you look at this is that Tesla is not the most efficient company in the auto industry. It's the least efficient company in the auto industry. In order for them to make enough cars to compete with GM, they would need something like 5 times as many employees as GM. So not only does Tesla not have the workers to build enough cars to be competitive with the auto industry in terms of cars produced, but they are so bad at making cars relative to the rest of the industry that they need 2 or 3 times as many employees. And by the way, those employees all cost money, and they would all, that's one of the things that's contributing to the losses, is that they're just not very efficient. So they don't have the workforce to build the cars they need to build to be competitive relative to the market cap. Even if they got all the offers, they couldn't perform. Even if somebody came in today and wanted to buy 10 million Teslas, which they don't, Tesla couldn't deliver them. And in order to deliver them, Tesla would have to find employees that I sincerely just don't even think exist. So let's go back to some regular charts that you see me look at all the time. And this is something that is just sort of, it just sticks in my craw. Tesla has been diluting shareholders since 2009. In 2009, there were 45 million shares outstanding in Tesla. Since then, they've sold shares to the market to finance their operations every single year. If you'd owned 10% of the Tesla stock in 2009, today you would own 2.5% of the stock. So you'd have been diluted 75%. Now, I know people are going to tell me that, yeah, but the stock has gone from X to Y and those shareholders have all made a ton of money. And they're right, but if they haven't sold them, and what I think is going to happen is the market's going to catch up to Tesla and its price is going to drop, then this dilution is not a good sign. Companies that are doing well, that are well run, that are profitable or have a chance to be profitable, those companies aren't diluting their shareholders by 75%. And as a shareholder, you shouldn't accept it. You should say, if this is the way this company is going to treat me, I'm not going to own that stock. So this chart looks at the company's debt. And again, they're financing their operations through, by the way, one of the ways they're financing their operations is by taking deposits on cars that God knows when they're going to produce. Let's set that aside and say he's actually going to produce those cars because, he did get the Model X out, the Y is coming, who knows, maybe the Semi arrives one day. I'm not going to hold him to account for that, but it is worth noting that there is debt there. He is funding his operations in part through deposits, but he's also funding it through selling shares and diluting his shareholders, and he's also doing it by piling on debt. And this company has a tremendous amount of debt, and I wonder how much longer people are going to be willing to loan them money when there's no profits in sight. But this is how much debt the company has. You can see that it's gone, it's one of those up and to the right is not always good when looking at charts. And in this chart, it's really, really bad. So in summary, Tesla makes no profit. That's the number one job of a company. And as a value investor, the fact that the company makes no profit, never has made a profit, and is unlikely to make a profit in the foreseeable future is all I need to know. I'm out. I'm not buying this stock, and I would really advise everyone I know and everyone I love, don't buy this company. I know it's exciting. I know that Elon Musk is the greatest genius since Steve Jobs, and I probably agree with that. I know that, electric cars are going to save the environment, whatever. I know they're the first mover, and I know he's got the solar roof, and I know, but I don't care. The company doesn't make any money, and it's not going to make money in the future. That's all I need to know. Don't bother me. But again, I could forgive you if you weren't a value investor for wanting to buy it because there's so much hype. So that's why we need to go on and talk about the rest of these things. Tesla has a market cap equal to 23% of the 10 largest auto manufacturers. That's despite the company having no profits. It's also, more importantly, despite producing less than 1/2 of 1% of the cars made by the auto industry. So it is 23% of the market cap, despite the fact that it has half of 1% of the cars produced. Something there just doesn't smell right. The auto industry as a whole has an implied PE ratio of 11.9. Tesla does not even have profits, so it doesn't have a PE ratio, but if I gave them $1.3 billion to convert their $665 million loss to a $665 million profit, if I was generous enough to do that for them, then they would have a PE ratio of 262, which is, call it 25 times the PE ratio of the rest of the auto industry. And the auto industry is a very well-known industry. It's very easily understood. Everybody knows what cars they like and don't like. There's no reason to believe that the auto industry and that the $750 billion worth of investment in the auto industry doesn't understand how that business works and doesn't understand why Tesla is unique. The auto industry as a whole trades at about book value. Tesla trades at 26 times book value. The average additional market cap per car sold in the entire auto industry is about $11,000. So for every car sold in the auto industry, the manufacturer's value, market cap value goes up by about $11,000. That's in the aggregate. For Tesla, it's $500,000, 45 times as much. Again, really? By auto industry standards, Tesla's workforce is tiny. They can't possibly today produce anywhere near the number of cars they would need to produce in order to compete with the largest auto companies or to have enough production to justify their market cap. They'd need to have 10 times their workforce. They have, in fact, more than that because Tesla is very, very inefficient. They have a very tiny workforce and it doesn't make a lot of cars. Tesla has diluted its shareholders by about 75% in 11 years. Tesla continues to pile on debt and there's seemingly no end in sight. So you add all that up and you go, why would you buy the stock? Again, you don't have to buy Tesla. You can just pass. You can say, this one's too hard. Let someone else go make all the money on that because I believe sooner or later this thing's going to turn around and there's going to be tears. So take this video, share it with your friends. If you like the video, please subscribe, please like. If you disagree with me, please put in your comments why. And don't say, you don't understand, Tesla's great. Give me something empirical. And by the way, if you come up with something great, I'll throw it in the next video and I'll explain, hey, I was wrong. And I'll tell people who it was and what they had to say. And even if it's a counter argument, I'm willing to listen. But I don't think you're going to find a way when you look at the initial video that I did in April 2nd on Tesla and you look at this, that you're going to come back and say, yeah, the more I think about it, Tesla's a great buy. I should buy that stock. Thank you very much for your time.